after an incredibly strong September, equities have been mostly positive this month as well. But can the run last into the end of the year? And if not, what should investors be doing? Joining us from Cape Town with his view on the market is Peter Brooke, Head of Macro Strategy Investments at Omigsa. Peter, thanks so much for joining us this afternoon. Clearly, a lot of people divided as to how much legs the run still has on a global level. I mean, the JSE All Share is above 30,000. We've got the Dow Jones at around 11,200 points. Still very much divided as to where we could go from here. What is your view, given the fact that we did have a very strong September and so far markets looking pretty good for the month of October?
If you just look at the market, I mean, yesterday was up, today it's down. In the short term, we've got no idea. But I think the key thing is if you take a step back and you look at that September return, it was phenomenally good. It was 8.8%. And in fact, without the strong Q3, which is it's delivered all of the returns for this year. In fact, the return on the equity market has just been 11.7 up to the end of September. All of that return took place in Q3, and almost all of it took place in September. And if I look back what we were saying in the beginning of the year, we would have said a 12% return. It's a pretty good real return. Well, it's an excellent real return with inflation down at 3.5, but it's quite a bit better than cash. That's all we would have hoped for the year, and it's happened. But importantly, it only happened in 1 month. And that just highlights to me the importance of sticking to your investment plan, because if you weren't there for September, you didn't get the return for the year.
Well, Peter, investors who weren't in the market for September, do you think it's too late for them to get into the market now, as Eleni said, with the All Share above 30,000 at this stage?
I think if you're looking to capture excessive gains on a trading basis, it probably is too late. The market is not that cheap. Clearly, with such a strong return, earnings aren't growing that fast. The market has re-rated. It has got more expensive in the last 3 months. But that's only if you are looking to trade. What most people should be looking to do is looking to invest. And then the important question is, where else can I put my money? And what sort of a relative return can I expect? The reality is cash yields are down below 6% in many cases. And with that, you're not getting a decent return, particularly once you take into account fees and taxes. You're actually going backwards in real terms in cash. So if I look at where equities are now, I do expect a lower real return going forward into the future than we've had in the last 10 years, and that's because we've had an excellent 10 years. But on a relative basis, when I look at that return versus what I can receive from cash, bonds, property, it still looks reasonable and therefore should form an important part of one's portfolio.
Well, wouldn't you be selling some of your profits at this point in time, given the fact that, as we said, over 30,000 points, we are expecting more quantitative easing in the US, so that could be quite a nice liquidity booster going forward, and that money could land up in the equity market or could land up in the bond market in South Africa. Some of the investors we chat to say it is a good time to book profits. Would you say that this is a wise idea right now?
I think what you're really talking about there is a tactical trade. So has the market gone up too quickly in the short term? Probably a little bit. But you've got to have the shares to sell in the first instance. And I think for most South African investors, they don't own the shares anyway. So that's actually the problem, is it's a theoretical question. They're all invested in cash. In terms of shorter term market timing, I think the big unknown is what's going to happen on quantitative easing. The market has priced a fair amount in, and therefore how much more upside can we expect? But in the long run, what we're seeing is very, very low cash yields in the developed world. It means cash is trash. You're not going to get a return on that. That's pulled down the return on bonds, and the potential return you can receive from that is very low. Therefore, the more liquidity that gets pushed in, the more likely that liquidity is to find real returning assets. And in South Africa, we still have a number of assets that give a decent real return.
Of course, Peter, we know that lots of foreign investors are keen on South African equities just because of that money-chasing yield. We've also heard that probably a good time to look for some value offshore. Would you, as a South African investor, perhaps be looking offshore given the strength of the rand at the moment?
In principle, we think diversification is a good idea. Don't put all your eggs in one basket. Having some money invested internationally makes sense. It reduces your country risk, it reduces your portfolio risk. And if you look at it, international equities have just been in a 10-year bear market. therefore there's definitely more value than there used to be. But I wouldn't take money offshore and put it and give it to the banks. And I wouldn't put it in government bonds because the level of return that you're going to receive is atrociously low.
So would you be stock picking at this point in time when it comes to the developed world? I mean, we're chatting to some strategists earlier this week, and essentially they say, you've got to look for the value, and some of the South African stocks are just not offering value right now. I mean, we're at 30,000, as we mentioned. That's around 10% off the all-time high ever hit on the JSE All-Share at 33,000 points. And perhaps earnings haven't really started matching up to the rises that we've seen on the equity front. But the question is, how much further can we actually see earnings rising? And, of course, that could just mean that we're looking slightly expensive in comparison to some of the developed market stocks.
I think in terms of what you pay is what you get, the issue around earnings is true. I think it's going to be a very tough environment. I was at a banks conference yesterday. Standard Bank are talking about firing 2,000 people, and senior people at that. That just highlights that the earnings outlook out there is going to be very tough. But you've got to remember is what can you get with your money? So if you're only getting 5% in cash and you're only getting 7.5% in bonds, maybe 8% now with yields having kicked up a little bit, your multiple that you pay for earnings should be higher. So yes, the PE on the JSE is above average. Therefore, it's not offering exceptional value. But it probably should be above average considering the climate that we're in with very low returns out there. In terms of your question around international equity, I think there definitely are some shares that are offering value, and particularly relative to their cash and bond yields. I mean, you just look at Japan, it's got a dividend yield of 2.5% with a zero cash yield and a bond yield of next to nothing.
Peter, property, would you be including property in that diversification? Because we know that property funds, property shares also have done very well so far this year. In fact, property shares giving a total return of more than 30%. Is there still more upside to that, do you think?
Well, listed property has been the best performing asset class in the last year, in the last 12 months, and it's been the best performing asset class in the last 10 years. So it's been a phenomenal place to invest. Typically in our funds, we've had a fairly large exposure to that. We saw it as a key asset class, and in terms of our strategy, we therefore allocated our clients' money to that. Clearly, a lot of that return has been driven by a re-rating. Property was very cheap. It's now no longer as cheap as it was. Therefore, your expected real return into the future has decreased. So when we look at it, I would say there's less value, and I'd say there's actually less value in almost all South African asset classes. So people have to get used to the fact that returns in the next decade will be lower than in the last decade. And that's a really key message that people need to get. In terms of if I look at property at the moment, it has done very well. It does look a little bit overbought, but you look at that yield of 7.5% or so, I find it very hard to replace that in my portfolio. So I think keeping some property in a portfolio does make some sense.
Well, Peter, could you break it down for us, just looking at asset allocation from a percentage perspective, between equities, bonds, cash scenario and property? How are you allocating right now?
It's really going to depend on the solution. So every individual is different. If you're a young person, you're going to need to own more in equity. If you're an elder or a retired person, you're going to have a higher proportion in income. So you want to have a mix, and the solution should suit what your requirements are. But I think if you look at it in terms of offshore diversification, you clearly want to be in offshore equity rather than in offshore cash and bonds. And within that, I still think emerging markets offer a reasonable value going forward. I think you do need to have a core holding within growth assets. And by that, growth assets, I mean equity and property, because that's the only place that's going to give better, reasonable real yields. So a diversified portfolio, but you do need to have growth assets within it.
Peter, you keep on saying that investors have to look forward to lower returns going forward into the next decade. But don't you think that the South African economy has also undergone a structural shift where we're going to have lower inflation going forward as well? So those real returns might not be that much lower going forward.
I think the whole debate around inflation is going to be driven by the world inflation story. And certainly in the developed world, with the degree of overcapacity, both in terms of factories, but more importantly in terms of people, we don't see a strong inflationary pressure coming out of that area. Where you would see inflation is coming from the emerging world, where you are seeing reasonable growth. But you're absolutely right, because as I highlighted, the cash yields that we're seeing are the lowest we've seen actually pretty much since the 60s, other than a bit in the 1973, 1974, and a bit in 1979 and 1980. But the difference is around real yield. And in terms of South African inflation, I think the pressure from global inflation isn't going to be that great, but we're really under a lot of pressure to manage our own inflation down. If I look at the high wage increases, it's making our companies uncompetitive, and does put rising inflationary pressure into the system.
Peter, what is the biggest challenge facing the global economy right now, which is obviously going to have a direct impact on South Africa? And also just looking at the third quarter GDP number out of China, 9.6% inflation creeping into that market, 3.6% for the month of September. Apart from that, we've seen massive austerity measures taking hold of Europe, and then you've also got a very much deflationary environment in the likes of Japan and the US. So a lot of things to take in, but what would you say the overriding challenge will be going forward?
You're absolutely right. There are a number of challenges, and each month or each quarter will bring up a different problem. So at the moment, it's foreclosures in the US not being allowed in terms of not having followed the right legislation. Previously, it was Greece, and I'm sure we'll have another problem somewhere else in the world in the next month or so. That's the nature of macro news flow. It ebbs and flows. But I think the key challenge is going to be growth. There's not going to be very much of it in the developed world, and that's going to put pressure on employment. I think that's going to put pressure on politics. I think it's going to be a fairly tough time for the next 5 to 10 years.